right, what's up, everybody? Welcome back to episode 2, the Fresh Finance Podcast. My name is Thomas Elms. Got my co-host here, Kyle Ryan. Today, we are going to fire off on kind of what I think is perceived as the most, I wouldn't say the most exciting, but kind of the most talked about piece of financial planning is investment planning. You know, how are you building out portfolios? What type of accounts should people be looking at, whether it's, you know, traditional retirement conversations, or if we're looking at non-retirement conversations, what are some of the vehicles that are available? You know, how we work with clients and households on building out portfolios. What are some of the things to be looking for? Pieces like that. So Kyle, if you kind of want to get us, you know, started off on this investment planning conversation, would love to just kind of get your take on how you as an advisor, as a certified financial planner, you know, how you begin to approach this conversation.
Yeah, investment planning, it's the sexy stuff, right? It's what you always think of when you think finance, not the actual planning piece.
Yeah.
Yeah, investment planning is really, really exciting because there's a lot of different facets to it. And, you know, one thing that Thomas and I really want to bring to this podcast, the reason we want to have a full episode dedicated on it is because as CFPs, as fiduciaries, we take a different approach to investment planning than simply, you know, broad stroke recommendations, because every single individual's goals for investing, while it could be as simple as make me money, you know, your time horizon and what you're working with, your investment vehicles, is all very situation dependent.
Yeah. So,
you know, we as CFPs and as financial advisors, we work with clients to help build more diversified, more diversified portfolios suited for their goals. And not only that, but help to create and establish a mindset for long-term investing and helping them understand what those goals are and not to be deterred by short-term hiccups in the road.
Yeah. You know, and I think that long-term mindset's so important. And it's a lot, honestly, it's a lot harder to actually buy in and live through that mindset than a lot of people think, especially when they're first getting started out, you know, because just kind of case in point, I've got a couple of clients that we onboarded here back in probably September, October, November, call it, kind of in that 3-month time span. And, you know, we really took the time to say, hey, this is the portfolio that we've developed. We've, you know, really back tested the track record, the history, the performance, you know, and the overall diversification of these portfolios. And regardless of what you're in right now, the market's just getting cranked. You know, the market is getting hit. You know, today is Tuesday, the 22nd. It's down 600 points right now. You know, and there's a really tough conversation to be had about the mindset of really actually adopting this long-term conversation of being an investor, when, especially if you're working with a new group, and the past 3 months have been fairly bloody. You know, it's really just kind of sticking to that. I think that's super important. You know,
and if you even like zoom out and think about why.
Zoom out. Love that.
Yeah, typically if you zoom out, you think about why, you know, if you look at any market downturn, fear and uncertainty can be the cause for almost any of them. Right? I mean, think about, you know, you go back to March of 2020. No one had any idea what was going on with COVID and the pandemic. Very few thought we'd still be dealing with it today. So it shows how the market went down 35% in a 5-week span. Like that's
10,000 down points.
That's how quick uncertainty can take fold. Now, if you sold at the bottom because, you know, you didn't have this long-term solution, this long-term mindset, you could have panicked. And there's I have clients, I've heard stories of people, you know, it's really difficult to stay the course in that time. But that's kind of the idea, is anytime historically, you can always look back and say, why'd you go to cash? You know, you always kick yourself. Long-term, the market historically has gone up, and therefore, always up and to the right, you know, and that's kind of the idea, is being able to zoom out, take a step back, and understanding your approach. Do you need the money today?
Yeah. You know, and that I just kind of came to my mind here. I think that's such a good conversation on the difference between being like a trader, being a speculator, where you're just trying to essentially buy something at a price and hoping to sell it to someone else at a price higher. That there's a lot of value in having that conversation, because, you know, whenever we're working with households, you know, the households that we serve, we're really focusing on making sure that everybody, at least to some degree, understands what they own and why they own it. I think that kind of if we could dwindle down the investment conversation to two sentences, two questions: what do you own and why do you own it? That plays such a more important role in the long-term side, because if you own something and it's down, but you know why you own it over a long-term time horizon, I feel like the comfortability, the security, the knowledge that things will recover, it's so much stronger there.
That's a really good point. If you
Yeah.
understand the story, then it could make it much of an easier process. And that
Yeah.
kind of can segue into this next piece of understanding, you don't want to hold a falling knife at the same time, right? Just because you understand something, you have to be able to know that it is a good long-term company. There's plenty of companies out there that over the last 10 years haven't done anything.
Yeah.
Right. So you want that mindset, but that goes into understanding your different options in investing in the investing world. And, Thomas, if you want to kind of break that down a little bit, what are some of the different investment options, being stocks, bonds, what have you, that, people can get involved in investing?
Yeah. I mean, kind of count them out here: stocks, mutual funds, exchange traded funds, ETFs, fixed income, which is almost always bonds. And then from an alternative side, there's a lot that we could kind of go down the rabbit hole, but the primary alternative would probably be a REIT, so a real estate investment to trust. So I kind of liken that similar to almost like a mutual fund or an ETF, but solely invested in real estate. And really kind of diving into that, it's kind of an interesting transition, at least from a historical perspective, that I feel like we've seen, because back early, I would say probably early 1900s, probably 1970s, 1980s, the bulk of investors were, the only vehicle they had was to be in the market, to be in stocks. 60s, 70s, 80s, we start rolling out mutual funds, where essentially a mutual fund is a basket of stocks, or if it's a fixed income fund, it's a basket of bonds. And so what it's able to, to allow an investor to do is they can buy in at a certain price and essentially own small pieces of a large number of companies, right? And so that's kind of a similar explanation of how exchange traded funds and ETFs are created, except the way in which they're traded is a little bit different. And there's also some more positive tax benefits to the exchange traded fund, in the fact that they don't pay out normally with mutual funds, they'll pay out an end of the year capital gains distribution. And that distribution, if it's inside of a non-retirement account that isn't tax deferred in its status, that's going to be a situation that's taxable to you. So there's kind of conversations with that. And then, you think about real estate, owning something in real estate. And I know we'll get to the diversification conversation, but owning real estate, is something that's considered what's called a low correlated asset to the market. So, when I talk about that, correlation essentially, and it kind of describes itself, but correlation is all about, are they moving in parallel directions, right? Are they responding the same to different, global market events, right? And so there's a piece to that as well. And fixed income on the same side is you're essentially buying debt. You're a debt holder of, whether it's the US government, whether you're buying corporate debt, so you're being a debt holder to corporations. There's a lot of different aspects that really play in it. And I think the piece for us, and there's kind of been an analogy that's been floating around social media I really like, is there's so many different investment vehicles out there, as far as investment types that we've been talking about. And I think it's our job as, certified financial planners, as investment advisors, to kind of help take this jumbled out, almost like, when you dump out a puzzle box and there's just puzzle pieces all over the place, just kind of figuring out how we can individually put those pieces of the puzzle together for each client in a way that, represents their time horizon, represents their risk tolerance, and kind of what they're looking for.
I think you wrapped that up really nicely. I mean,
doing my best.
Yeah. I mean, you summarized what each of them are pretty well. And the only thing I'd really add is, like you mentioned, stocks were really the only way that people could get into investing. The world has been evolving and becoming more lower cost, if you will, for these expenses. The mutual funds, ETFs, they used to have a pretty hefty charge associated with them, because people actually have to actively manage them, as opposed to going and buying a stock. Boom, you did it. You bought that stock. there's companies that create these mutual funds, these ETFs, exchange traded funds. And honestly, I think the world is moving a lot towards these actively managed funds, because I think active management is very important, especially in the landscape that we're in today in the investing world. So, in terms of, it's kind of the old all your eggs in one basket with a stock, right? Because Apple could be the greatest company in the world, but if something happened, if some weird thing happened to any company where their CEO does something, or they could quickly become subject to some sort of risk that they can't really control. So that's why I personally like getting the diversified nature of a mutual fund or an exchange traded fund there.
Yeah.
So that's a good intro into really what you have available there. Then, one way that we could spin it around here even further is the types of accounts that you can get into. Could you kind of give us some insight into, now that we know what we could trade within our accounts, what kind of accounts could we have?
Yeah, and that kind of, we break it into, I would say two different kind of systems here. Is you're either looking at a retirement account or you're looking at a non-retirement account. So the kind of the difference is the taxation or the opportunity for deferred tax status for down the line, right? And so kind of on the brokerage piece, because it's the easiest, traditionally, the option for that is just setting up a brokerage account, setting up a non-retirement account where essentially you have the ability to contribute or distribute as much money as you'd like in any given year or time frame. And it's not really earmarked for anything. This could be a house fund, this could be a car fund, this could, just be a liquidity account, right? You're just trying to, generate additional liquidity outside of a checking or a savings account, which a lot of people are starting to go to because, returns on CDs and savings accounts are just not getting you anything anymore. I was talking with a client last week, and he was telling me about, he had a CD in 1987. Listen to this.
Oh, and it's got to be paying.
He showed me, he had a copy of it, and he had a CD that was paying him 13%.
Oh, that's incredible.
13%, a CD, but here's the thing on that, and this is where this whole interest rate conversation is very interesting, that we're seeing right now with the Fed over the next couple of months, even throughout the remainder of the year, is everybody thinks about that now and they're like, oh, CD at 13%. That's incredible. Like, I wish I could just have that, get my instant 13%, good to go. What a lot of people forgot is mortgage rates were 13% back then.
Oh yeah. All interest. Yep.
And so there's kind of that trade-off is, recognizing if you want risk-free return, thinking about CDs, thinking about savings accounts that are FDIC insured, you got to think about the idea of, if CD returns are really great, and I know I'm kind of going onto a tangent here, but if CD returns are great, that means interest rates are high, right? So, you can't have your cake and eat it too. But kind of transitioning from the brokerage side, looking at retirement, and, kind of within retirement, I break it into, into two segments. I know we've talked about this before, but looking at, if you are kind of a W-2 salaried employee, normally, you're looking at having a 401k at your employer. Depending on that employer, you can have a traditional or a Roth side. And then, kind of on an individual basis, you've got a traditional IRA and a Roth IRA. Second avenue is being somebody who's self-employed. You're looking at the opportunity to have a solo 401k, the opportunity to maybe doing a SEP IRA, or, kind of further down the line, kind of an additional piece if somebody's already maxing one of those two out, is looking at maybe a cash balance pension plan, which is kind of the ultimate super high contribution rate retirement vehicle as far as tax deferral. And we're planning on having a retirement episode where I'm sure we'll really dive into those on a deeper level.
Yeah, and one of these future episodes, I'd love to get into the prioritization of planning, but just sticking in the investment topic here, in terms of investment options, the only one that's significantly going to differ from the rest is in your 401k, you're typically going to have a lot less options than you will in an IRA or a brokerage account. An IRA and a brokerage account, you can invest in anything that your financial institution houses. If you're at Fidelity or something, you can invest in anything under the sun. Whereas in a 401k, you're going to have a set amount of options. I've seen 20, 30, usually in that ballpark right there, right? And that's because they're deemed by the company offering you the 401k to be suitable for anyone's risk tolerance, any investor. So you'll notice that that's a difference that we sometimes note in 401ks versus other types of accounts that you can invest in.
Yeah.
And this is sort of a broad stroke, and it's not, and everything in financial planning, in our opinion, the answer is usually it's dependent upon your situation. It's not black and white. But one thing, if I could leave the investing piece of the investing vehicles here, is that if we ever had a priority of how much risk is in account in terms of the Roth, I'm going to stick with Roth, the Roth IRA, Roth 401k, either one, the traditional IRA or traditional 401k, and then your brokerage account. If I was going to be aggressive in any of them, I'd be aggressive in the Roth IRA. Why? It's the one that grows tax-free. Again, we can cover how each of these, the different taxation works of each of these vehicles, but I'm going to stick my money. If I've got 30, 40 years, I'm going to stick in the one that grows tax-free. There's no doubt about it. Now, on the other end of it, like you mentioned the brokerage account can either be, if you're saving for a car, you're saving for a house, you're saving for a rainy day. This could be an emergency fund. You just had some extra cash in the bank you wanted to get invested. This one I see is highly liquid. Your retirement account, you don't want to touch till you're 59 and a half. Your brokerage account, typically the way I invest is this is the one that if I had to break beyond the bank and I'm going into an investment account, this is the one I'm grabbing from. So I'll have a little bit more of a conservative risk tolerance in that one.
Yeah, I love that what you just said there, break beyond the bank. I feel like that should be the investor ideology behind a brokerage account is you only want to take money out of that account if you have a situation that's breaking you beyond the bank. Yeah. Because if you set up a brokerage and are putting money in but taking money out just as fast, you're never going to see that growth that you're looking for. Because if money's coming in and then almost immediately going out in a way, there's definitely a conversation to be had about that. Yeah. And one more thing on the retirement side that I've actually, and this is kind of where sometimes the disconnect, and I would just say kind of, lack of education or not necessarily asking the question of the right person. But it's just so interesting for me to hear this is I get a lot of people that are curious about the different investment options that are available between the different retirement account types. So like 401k, Roth IRA. One of the things I really want to hit on it, and there are some pieces to this that aren't necessarily 100% correct, but one of the things I want to hit on is you can invest in virtually almost the same exact things as far as like exchange traded funds, mutual funds, and any account type. Because, a lot of people will say, oh, like I've got this, this traditional 401k. If I roll it into an IRA, will I have the same, investment returns? Will I be able to invest in the same things? And the ultimate answer is essentially yes. If you were to almost kind of like roll them out and kind of keep it into the account, it's the same. Now, can you invest in stocks in a 401k account? Not with one that's normally held with an employer. If you're a solo individual, there's a little bit different options there because, I don't know about Cetera, but at LPL, we've got the ability to directly hold, solo 401k assets where we have the ability to, invest those as the client sees fit.
Yeah, I mean,
that's just one thing I wanted to hit.
Oh, no, it's a great point. And honestly, it's you could also sometimes you have a company who offers their own company stock, which opens the door for net unrealized appreciation. But that is another episode as well.
Yeah, get to that one later.
Exactly. So roll on from the retirement conversation. One thing that we're just kind of piecing together here. So all of a sudden what account you want to invest in. For one reason, right? Let's, you got your Roth IRA, you're going long-term, right? Now you've decided, okay, I'm going to go with either stocks, ETFs, mutual funds, what have you, right? So now you made this decision, you've got this goal of investing here. Now, what I want to turn this to is the value of diversification. And the value of not putting all of your eggs in one basket. So Tom, do you want to shed some light on what diversification kind of means to you within a portfolio in a way that, investor can achieve it?
Yeah. I would say diversification, and this is where, sometimes a conversation like this can go a couple of different ways, but, we've got the cliche, don't keep all your eggs in one basket. But the way that I like to look at it is taking your money and distributing it in an effective way across all different market opportunities that allows you to create opportunities for growth, but also for downside protection. And the reason why I say that is, and they've done studies on this before, and there's no guarantee of future market performance here, little disclosure,
Good
but
disclosure. There you go.
yeah. But, one of the things is when you're building out a balanced, diversified portfolio, what you're really looking at is something that is going to mirror the index on upside performance, not necessarily going to beat it. And then it's going to do better when markets are down. I think that's one of the biggest pieces. And that's the biggest piece to long-term growth, is because if you can mirror upside and mitigate or be better on the downside. So let's just say, there's an index that you're tracking that's down 20%, right, over a given year, whatever your time frame is. If your balanced portfolio is only down 10 or maybe only down 5, you've beat the index in that bad market. And that's going to allow for when the market does correct and go back into more of a bullish mindset, a more of a growth oriented mindset, it's going to recover quicker, and it's going to allow for more opportunities to continue to grow. And one of the conversations there that I always tell people is, if you truly have a diversified portfolio, something is always going to be up and something is always going to be down. And that's the really hard part, is seeing something that's down in an up market, kind of your 2018, 2019 market, right? Where, you could have thrown a dart at a dartboard and you would have hit anything, it was green. Yep. Right. And just kind of having that mindset that understanding a diversified portfolio is having things that counteract each other, because you want things when the market is up, they're up, but you also want to have things in your portfolio over the long term that when the market is down, it's up. It's kind of back to that low correlation mindset.
Yeah. Just a quick aside, I remember in that 2018, 2019, people who were value investors, they were getting their measly 18% return, and they were getting mad at the growth investors who were getting the 30, 40%. It was absolutely nuts at that time. So yeah. That's a good point. And, there's diversification can really go a million different ways, right? So, diversification in purely stocks could be the size of the company, what exactly they do. I've had clients who come to me before and they say, electric vehicles, age of electrification, the 2020s. Yeah. Let's get into it. Absolutely. 100%. I love the idea, but I'm not going to put 100% of your portfolio into either one stock that's electric vehicle, or even if you came to me with 15 stocks that were all electric vehicle. That is not diversification. You need different sectors. So that's a really good point. And what the purpose of the company is, what the purpose of the ETF mutual fund, you want to vary those in different sectors, right? Yeah. The size of the company, you could have mega cap companies. Everyone knows the Apples, Amazons, Googles of the world, and then you have. So, the amount of risk in those types of companies is different than the amount of risk in what could be a really tiny mom pop around the corner store, right? Yeah. Because let's say hypothetically you got a drone company, right? Really tiny drone company. That is much more likely to double, quintuple, huge increase in size than an Amazon, which would take a lot more to double in size. On the same side of the coin, it's very easy for something like that to fold because they don't have as much assets to, back up on, as strong as a balance sheet. So understanding the different risks associated with just understanding what type of company and mutual fund or fund you're getting into and where it fits in your portfolio, and understanding whether or not you're diversified from there. Yeah, is incredibly important.
Yeah, and kind of on that company size conversation, normally whenever we're looking at building out a portfolio for, let's just call it a growth investor, somebody who's got 20 plus years on their time horizon before they plan on taking, any monies out of an account, we're always building out as looking at large size company or ultra size companies, large, mid-size companies, small size companies. So if there's ever a time where I really emphasize a fund option, a mutual fund or an ETF, I'm always really, trying to emphasize the idea is if we're looking at small size companies, I really like to go the fund route because of exactly what you just said. They obviously have the opportunity to, 3x, 4x, 5x, 10x, but the risk associated with that in comparison to most people's risk tolerance, they just don't have that capability. Now here's the other piece to that. And this is where I think having the S&P 500 index conversation is really important. is if you are of the mindset of, hey, I'm just going to buy the index, set it and forget it, see you later. That's not necessarily a balanced portfolio, because what you're essentially doing is you're just buying the 500 largest companies in America. And what happens is you might be kind of mirroring and tracking the quote unquote perfect performance number because it's the benchmark for performance. But what you're missing out on is the companies that will eventually replace the ones that are currently in the index, right? So just kind of a backstory on this. The S&P 500 index, like I said, it's essentially an index of the 500 largest companies in America. Well, the companies that are in there right now weren't always in there, and there were companies before them that were in there and aren't in there anymore, and so kind of what you're missing is you're missing the growth potential and the buildup of those small companies becoming mid-sized companies, and those companies become large, and then ultimately becoming, that mega cap space that's in that index. Is you're missing out on those opportunities to participate in the growth that gets them there.
Do you know what the one fund, if you looked at the top 10 holdings in the S&P in the year 2000, there's one single holding that's still in the top 10 today?
I don't know.
It's me, Microsoft.
Oh, that would make sense.
It's the only one.
Yeah.
It's the only one. So what does it look like in 20 years?
Yeah.
Who knows? It used to be a lot of energy companies. Today, it's all technology companies.
Yeah.
Technology is not going anywhere, so we'll continue to be technology in 20 years. Who knows? But I think you make an incredible point there. You do miss out on a lot of opportunity out there if you don't do that.
Yeah, and kind of the idea on diversification is, you index your money. If you just buy the S&P 500 index, that's 100% of your portfolio. You're not technically diversified anyway, outside of maybe just owning, more than, call it, if you're just stocks, maybe more than 40 names, right? Because you own 500 in the index, but you are the market, right? And so you have no hedge against the market's performance, right? So you think about 01, you think about 08, you think about COVID, right? If the market's down, you are the market, right? So if the market's down, you're down. And when it's down big, so are you.
Yep.
Right. And normally, and I don't necessarily have the exact answer for this, normally index funds will almost always underperform on the upside just by a tick, but they're almost always down more than the index in bad markets.
No kidding. But I think that is another sort of good segue into discussing and understanding one's risk tolerance. And risk tolerance, I mean, that feeling you get in your stomach when your portfolio goes down, you're like, oh my God, what did I do? Or the lack thereof, right? Because you understand your response, you understand your goals. This is a big job as a financial advisor. One of the biggest things is controlling the emotional side of things with objective thinking, right? Understanding that you're an investor in their 20s or 30s and they've got the Roth IRA and any account really that they know they are not a retirement account. And the market's going down, Kyle, everything's down 10%. That's okay. It's really okay for your money to be down a little bit at sometimes because that's expected, right? This is that you're going to not touch this money, hopefully for 30 plus years, right? You're going to continue contributing into this. Me personally, when I see this kind of stuff going on, I'm like, Roth IRA, happy days, right? This is my buying opportunity because I understand that everything I do for the next years is going to come out to a point where I'm going to be using it for retirement. It's earmarked for retirement. So understanding my risk tolerance for that account versus if I am saving for a home in a year, I probably wouldn't take the risk and put my money into the market right now because why would I take a $10,000 investment that I know can go into a home today, hoping I can increase it when the very much reality of it is I'm putting it at risk and it could go down.
Yep.
So understanding that piece and what your goal and your objective as an investor is will very much help you with these pitfalls in your stomach that you get when you check your account balance, right? Because one thing I've noticed, I'm sure it's the same for you, Thomas, is that risk tolerance is never higher across the board than when it's just nothing but green in the markets, right? When the market's cruising along, everyone's 100% stocks. Put me all in. And then you get a couple down days, it's like, whoa, I forgot what that was like.
So it's a good reminder to kind of reinforce the idea of having a strategy, understanding what you own and why you own it, and having that long-term focus, because you're right. I mean, it's kind of like a, like a midnight slap in the face that wakes you up, when everything's green, and then we've got maybe 4 straight down days, right? It's kind of that realization, hey, this isn't going to just be green forever all the time. I think that's totally true. And one of the things that I like to always ask, especially if we're onboarding somebody, to kind of, I'm not necessarily scare them, but kind of impress on the mindset, is say, hey, we move this money over, we start working together. What happens if your portfolio is down 10% over the first 3 months, right? What happens if it's 20, 30, 40, kind of depending on how we're allocating? Because I'm not going to, have a super conservative investor and say that, right? But if somebody's in a growth mindset, we'll always ask those questions. And
that's a good idea.
I really like asking that, because that's kind of the telltale of the past 3 to 4 months.
Yep.
We've onboarded clients that luckily we've been able to kind of prep them for this type of a situation, because one of the hardest things, and I've really started to realize this, but one of the hardest things for normal investors that aren't advisors to do is give up the reins on their investments, and give it to somebody else. And it's even harder to give it to somebody else and then have a market event that is obviously out of you and I's control. It's out of everybody's control, but it's out of our control, and portfolio values decrease, right? And so that's just kind of, for the millionth time today, re-implementing the idea of having a long-term approach and understanding what you own and why you own it.
Yeah, I've had clients ask me even recently, it's like, oh man, you must be getting blown up with phone calls of clients asking about the market. It's not really, because just like you said, when you meet with these clients, you set expectations as an advisor.
Yeah.
That we have a plan, we're actively managing it. And you just give them, constant little touches saying, we're here. That's what people are most reliant upon.
Yeah.
Paying you a fee, be there for me, keep an active eye on it. And that's what we're here for.
Yeah.
And one other piece of it is, when things are down, there's such thing that you can do to continue to diversify and manage your account, and that's called rebalancing. So Thomas, do you want to kind of elaborate a little bit of the importance of rebalancing and the impact it could have on your portfolio?
Yeah. So rebalance is essentially kind of bringing everything back to the state, what I say, the state at equilibrium, right? And that's kind of that'll be the biggest word I use today, I promise. But essentially what I'm meaning there is, whenever you have a portfolio, your portfolio is 100% of its value, right? It's, all of the monies and cents that are included in that account. And what you're doing when you're building out a portfolio is you're signing allocations or weighting percentages of each fund or stock or bond or, real estate investment or trust that makes up the entirety of the portfolio. And so when you come up with the specific weightings for each fund, and some people do that differently, and I'll talk about mine here in a bit, but you start it and then the market happens, right? Some things are going to go up, some things are going to stay flat, some things are going to go down, right? But the important thing with rebalancing is coming back to the portfolio and getting back to that original allocation, right? And so that means that sometimes you have to trim your winners. You got to sell some of that. Sometimes you got to buy back in more on some of the short-term losers, and just kind of keeping that state of the equilibrium. It's super important, because what happens, and I think this is case in point for the people that have really got hit really hard on kind of a paper value. People have gotten really hard over the past probably 4 to 6 months, is they had huge upside in back half of 2020, first half of 2021, they didn't trim those winners. And a lot of the high flyer growth names got hit really hard past 4 months. And they're kind of back to their original value about 1.5 years ago, right? And so that's the importance of that trimming, is keeping your position sizing to what you've said it is, and just updating that. Some people do it quarterly, some people do it semi-annually, some people do it annually. It just kind of depends on what your overall strategy is. I think income kind of has if you're receiving dividends or any sort of interest, that plays a role as well.
Choose it a bit.
Yeah.
Yeah. No, I rebalancing is incredibly important. You can do it as often as you want, but like you said, it takes the emotion out of it. That's the overall point. You know, you set this plan at one point. Unless anything has changed with the plan, you always have your, you know, your fundamental percentages that are always set, that you always want to reset to the mean.
Yeah.
Right. So yeah, you know, whether it's being able to tax loss harvest, capturing those losses, selling the gains, you know, it's just a way of being able to come back to a means, come back to equilibrium. And I think you know, rebalancing on a, at least I like, you know, on an actively managed portfolio. Of course, every situation is dependent, but we try and focus on probably quarterly depending. And then as the market deems fit, I mean, when you have a 10% movement in a month, changes the system a little bit as opposed to what normally is, you know, market fluctuations in a given time.
Yeah.
So yeah, I agree. You know, rebalancing is a very, you know, important integral piece that takes the emotions out of it and reinstates your objective original approach.
And I think it helps on the risk tolerance side as well, you know, because if we just stick to the plan, right? Sticking to the plan, whether that's investments, financial planning, you know, you're looking at cash flow, whatever. If you just stick to the plan, it keeps expectations the same, and it allows for that strategy to optimize itself over the long term.
Yep. Yeah. One thing that's totally off base here, one thing I always like to tell clients too, that I haven't really mentioned, is that you're not trying, benchmarking is incredibly difficult, right? So if you've got an account that, you know, you're 100% stocks, what do you compare yourself to determine your performance? Do you do the S&P 500? Is that fair? So one thing I've always told clients to focus on is you're not trying to keep up with the market. You're trying to keep up with your plan. Right?
100%.
If your
Great point.
plan is, I've got 40 years, just average a good rate of return, right? Because you're going to do well over the long haul. If your plan is to retire in 2 years, you know, all of a sudden everything changes. You have to make sure that you maintain your account value because you're planning on retiring with X. If you keep it 100% in the market and the market craters, and all of a sudden you're way below X, right? So that's the, understand your plan and try and beat that. Don't be too focused on what the market's doing.
You know, I think that is such a great point, because I think that would bring everybody's associated risk tolerance with their investment objective much more in line.
Oh my gosh, it wouldn't be as emotional. Yeah.
You know, it would also, I think, expected returns for individual investors would go down too, especially young investors. Because if they know, hey, if I'm, you know, this age and I have this long and I want to retire with this much, if you actually plan that out and figuring out, you know, kind of factoring in how much am I contributing each year, things like that. Once you figure out all of those pieces of information, almost always you'll find that you don't need this ludicrous 15-20% annual return that everybody wants to have, right? It's just people are kind of, they're incapable of not just trying to max out just red line returns, right? I think it's just kind of this human nature, you know, this character trait that we have where we're just trying to get and receive and earn and return as much as we possibly can. But, you know, if that investment ever goes down, it's an issue, right? It's just kind of that disconnect.
Bigger they are, the harder they fall, right? I mean, there's certain things that we could get into where people expect more than 15-20% rate return. It's all about the mentality. You know, you don't want having that expectation of return. You have to be able to expect equally as volatile the downside, right? And you kind of see this in that 2018, 19, 20, where investing was uneasy, right? You can invest in anything, and you're kind of seeing that come back to the mean in the market we have today.
Yeah.
And that's why, you know,
100%.
it's incredibly important to understand all this, because investing can very easily be a roller coaster.
Yeah.
You know, it goes up and down. You know, one thing I remember, I read a Harvard study. I don't know how they figured this out, but you feel the emotions associated with a loss 5 times more than you feel them with a win. Meaning, if your account goes down, I hope you don't, but I know people are out there, they put it on themselves personally. They're like, oh my God, I messed this up. How could I possibly have done this? Right. And understanding that, you know, zoom back out, right? Do you need your money today? Do you need it in the next year? Understanding what your goal for that money is can help you kind of get through that. Because, you know, when we were at market highs, you know, I'm sure some people were sitting out there patting themselves on the back, but others were just thinking that they own that high, right? That's another thing, is people think they own that high. My account was worth this once, and even though it's half of that, I still feel like I should get up to that because that's what I had.
Yeah.
That's, another piece of understanding the entire investment world and what your goals and objectives are.
Yeah. 100%. I agree with everything there. And, it kind of brings into the conversation kind of the idea of selling. Sometimes that's the hardest thing that you can do is selling.
Easiest things to buy.
Yeah.
Hardest things to sell. Yeah, that's a whole conversation. I mean, again, it's very situation dependent, but one thing that we in our office have always call it a joke, but it's kind of real, is when you're contemplating selling an investment, this is not broad stroke investment advice, but I think it's interesting psychologically. Is there anything you're selling an investment, you want to completely get out of something? You're like, okay, I enjoyed the ride. I don't think the investment environment we're in is well suited for this anymore. One thing and you're on the fence, hardest thing to do is sell an investment. So what we sometimes say is sell half. Sell half. What can go wrong? If it goes up, at least you only sold half. If it goes down, at least you sold half, right? So it's kind of just everything, a lot of it's emotional and psychological, but that's one thing psychologically that we've kind of suggested to people is, of course it throws the entire rebalancing conversation aside, but psychologically we like to take that approach.
Yeah. And it's at least some sort of like an abstract question to ask somebody, is, hey, would you feel comfortable with this?
Yeah.
Because I think that's where we add a lot of value is if you're just investing on your own for yourself, you have nobody to bounce ideas off of. You have no outside advice. You're 100% emotionally invested in this process because it's your money.
Yeah.
And I was just talking with a client about this last week, is she was so appreciative of the fact that I wasn't physically, and emotionally involved in the conversation that we were having, is I could provide clear, independent advice that based off of her situation and my professional experience that I think could be a good outcome for her. What are the pros? What are the cons? And I think that's where a lot of this kind of comes into play. And on the selling side, one of the things that I do like about equities, about owning individual names, is sometimes it makes it a little bit easier to decide or have an idea or a strategy on when to sell something. Because normally when you're dealing with an individual stock, you have its current price, you're dealing with only that individual company. Almost always it's got some sort of a target price over the next 12 to 18 months, right? Yeah. So that's kind of where we're looking, or where a lot of the expert, institutional research people are expecting that price to go to. And you've got a kind of a back trace history of where that stock has performed, right? Problem with mutual funds is you got a basket, and and sometimes it's just tough to evaluate when to sell something like that. If you're just kind of not considering rebalancing, but you're just broadly considering maybe getting out of that fund. That's a piece too, because there's a couple of funds, to be completely honest, that because we're always keeping like a Rolodex, just a rolling list of individual stocks, whether they're growth, income, or kind of a mix of the two, and then different asset classes for mutual funds and ETFs that we're always looking at, whether we're using them directly or not. And there's some that honestly are kind of on the border for us that we're at that point where, like, hey, based off of their investment strategy, the current market environment, and their performance over the past 24 months, we're thinking about maybe getting rid of that fund. And that loss aversion piece is so important. That's the theory of loss aversion, that Harvard study is, people tend to feel losses 2 to 5 times harder than a win. It's kind of like gambling, right?
Yes.
You win $1,000 at the blackjack table, you're not going to feel as good as you felt, in the opposite direction as when you lost $1,000 at the blackjack table.
Yeah, because you feel like you own the high. You feel like you own that $1,000.
Yeah.
Right. Yeah. One other thing that you mentioned that I really like is that stocks, you can also set a floor, with stocks, kind of getting more into the advanced side of it, but stocks and ETFs, exchange traded funds, you can set stops. You could say, I bought this at $100 a share. I don't want to lose more than 10%. Cut it out at 90, right? You could do ones that are trailing, where it follows it up to a certain percentage, right? So I'll keep going with it until it comes down 10% from a high. So there's a lot of different options you get with stocks, with ETFs. They actually don't have a mutual funds, a little bit more of the specific stuff, but that's another way that you mentioned that, you can absolutely control your losses and control your investment philosophy in that way.
Yeah. that's just playing right into the risk tolerance conversation too. Because if you build out a quality portfolio with stocks and ETFs, just kind of thinking about, kind of calling those out inclusively inside of a portfolio, you can develop a strategy with, people like you and me that say, hey, this is what we're buying, this is the allocation. And if it ever gets to a point where it's down 10%, it's going to get sold.
Yeah.
Right. Or maybe a piece of it is going to get sold. And so that's kind of playing into that risk tolerance conversation. Now, I think that another conversation that we can have down the line about the efficacy or the effectiveness of stop losses, where that plays into actually having a long-term strategy. That's definitely a conversation, but I think all the same, it's a great point.
Yeah, I mean, you could get so in depth into the uses of the stop losses and the trailing stop orders and all that stuff. But again, another episode.
Yeah.
Last thing I would say is to kind of recap this is it's not about timing the market, time in the market, the old cliche adage, right? So, it's all about setting a plan and sticking to it.
Yeah. I'd say know what you own, know why you own it, and operate in the opposite direction of the average investor.
There you go. That's right. The average investor does not do well if you didn't know.
Yeah.
All emotionally focused.
The average investor wants to buy when markets are high, and the average investor wants to sell when markets drop. Yep. Operate in the opposite capacity of the average investor, right? Yep. So when the markets are high, trim. When the markets are low, buy.
Yep.
Right. It's just kind of that adage that has been through time kind of in this industry. And make sure that you have protection on the downside. I think we've got too many young investors right now that have come into the market, have come into money where they can actually invest good quantities, and they're just all gas, no brakes, right? And I feel like even though you have a long time horizon, you don't want to be overly aggressive or just inefficient. I would call it inefficient with your money.
Yep, that's good.
Right. And those are probably the things that I would say, to kind of sum up this episode.
Yeah.
This was awesome. Episode 2. I love it.
Yep.
I love it. Episode 3, it's going to be coming out. We're going to be putting out videos every Friday just for everybody's thoughts. If you're still watching, we're going to do Friday posts. It's going to be great. Looking forward to it. Looking at maybe some cash flow planning, some retirement planning here over the next couple of episodes. So stay tuned. We really appreciate you guys listening or watching. We're doing a little bit of both, and we'll see you guys here very soon.